Obviously, no one likes to play capital gains, but there's tools that we use.
What's the biggest frustration you've seen with clients, friends or family, when it comes to selling highly appreciated assets that they want to defer the capital gains tax on?
So I have this may be a unique practice. I mean, my practice, we work with a lot of very wealthy people, but most of the people we work with aren't as tax averse as many wealthy people you read about or you hear about. In fact, most of my clients would say, hey, we should have a little bit higher income tax on them. Obviously, no one likes to play capital gains, but there's tools that we use. So I'll just explain. One of the tools we use the most often, or especially this last year, has been a charitable remainder trust. So most of my clients have enough assets that they are in a position that they're giving it away anyways. So if you're giving it away anyways, and you have an asset you're going to sell that that's highly appreciated, has a low basis, you can actually tuck that into a charitable vehicle, whether that's a donor advised fund or a charitable remainder trust or something like that, and it eliminates capital gains when you sell it. You can't do it if it's encumbered by a loan. There's other rules and issues around it, but most of our clients, when they are faced with large capital gains, they're actually going to look to charitable vehicles to reduce the capital gain. And if you use the charitable vehicles the right way, you can actually create an income stream that lasts the rest of your life. And then the remainder goes to charity. That's what a charitable remainder trust is. And we've set up probably, I don't know, maybe half a dozen of those, this year, which it's been a great year for that, because you're right, assets, every asset, business assets, stocks, bonds are really good, but also real estate and private businesses are just the values have just gone off the charts this year. It's been incredible.
Yeah, fantastic. Yeah, we love the CRT, especially charitable minded and charitable giving. And if you're going to give it away anyways, it's a great vehicle. It's tried and true, and it's fantastic. For those who are not as charitable inclined, or maybe they're like, hey, I got 10 million and I'm definitely charitable inclined with 3 of it, but the other 7, perhaps with my family, or perhaps with just more different entrepreneur ventures. Like I have some clients that, one of them sold a primary home in Palo Alto for 8.3 million. And part of his goal was retirement for himself and his kids. He has 5 kids. So it wasn't is charitable. It's more like charity starts at home for him on those first 5 kids, right? So what are some of the things that are solutions that you've run into, or challenges you've run into for those who aren't as charitable?
Yeah, the things we've used in the past, and I know there's a couple other tools that you talk about a lot. The deferred vehicles, the 1031 exchange. You've talked about that. We've used those. Clients have used those. The Delaware statutory trusts, we've used those, so people get some diversification. I've actually run a lot into people that are done managing real estate, like they've built wealth through real estate and they just don't want to manage it anymore. So some of those vehicles actually have been pretty attractive. We don't broker those anymore. I did 7 years ago, but I don't broker them anymore. So we can advise on them. We talk to people about how to save taxes with using them, but they don't get them through us. They get them through other people, other brokers. They build them themselves through IPX, or this place out of Chicago that does it. Mm-hmm. I know you've talked about, and this is, I'm actually very curious about the deferred tax trust, because I think California has said no for California. Isn't there something that came down about that? I'd love to hear what your comments are on that.
Yeah, it's one of the, I call it the drive-by media, right? And so, sometimes people will take something out of context and then they'll run with it. So, the Deferred Sales Trust is based upon 1920s tax law. It's an installment sale.
Yep.
It's federal tax law, right? Just like IRC 1031 is federal, IRC 453 is federal. So the first thing to understand is the Deferred Sales Trust is based upon federal tax law. It's not a state specific. Second, the majority of our deals are actually done in California, and we've never had one single negative result in California in the 25-year history, including thousands and thousands and thousands of closes, billions under management. Now, this particular franchise tax board notice was sent to qualified intermediaries in regards to installment-like structures that were for those other, and we like to say we are an installment sale, right? But it didn't specifically say deferred sales trust, but structures that are not basically withholding what's owed to the franchise tax board. And we always withhold, and we always follow those rules. And so they were specifically targeting exchange accommodators that basically weren't following the rules as they saw it fit. And so they were noticing them. But some of our competitors, they write blogs, and one of our competitors for a lot of folks is the 1031 companies. And so they took that notice and they added deferred sales trust, and they said that California calls it illegal, right? And we've literally closed, I don't know, at least 10 deals in California alone, saving multiple failed 1031 exchanges this year, and have never had a single negative result. In fact, the biggest audit was to actually take place in San Diego, California. And it was a $125 million commercial property, and that was reviewed. That was reviewed, and that was a no change audit. And so it's literally batting 1,000, but there are those who don't want you to know about it. They want to keep a lot of clients in the Delaware statutory trust and or the 1031 exchange. But a lot of baby boomers, a lot of folks don't want to deal with the toilets to trash liability, and or they have like cryptocurrency or a primary home that doesn't even qualify for a Delaware, doesn't qualify for a 1031 or a business sale. So that's where we fit in. But it's it's interesting to see, and so far we're batting 1,000, and it's working perfectly. But you can learn more about that at capitalgainstaxsolutions.com. Does that answer the question?
It does. Well done. Well done. And it's funny. I would hate to be 25 and trying to figure this out today, because there's so much noise, and the noise is, like I said, like everyone is trying to sell something. And in that circumstance, it's 1031 people saying, you know what, this isn't good. Don't pursue this. Pursue what we do. Right. And I see that all the time.
Mm-hmm. Yep, it's the reality of it. But when the tax attorneys also stand behind their work. They provide lifetime audit defense, state or federal, and we also don't charge anything unless someone actually closes the deal. So it's literally like a no-cost due diligence period where you can review all this, we can go through it all, and like if you don't choose it, hey, no problem. Like someone's got to pay down the 29 trillion, right? Or go do the 1031. That's great. Like I'm a California real estate broker myself. I still help my clients do 1031s. I've done Delaware statutory trust, but it is interesting to see the calls that we get all the time about that. But it's a part of it. But